Welcome to Level Up Trading, the podcast where we focus on your edge in the markets through psychology. I'm Avery.
And I'm Melody. We're so glad you're tuning in.
Today, we're diving into a topic that's arguably more important than any chart pattern or technical indicator.
That's right. We're talking about the master key to consistent profitability, emotional intelligence.
Specifically, we're focusing on emotional discipline. Because let's be honest, you can have the best strategy in the world, but if your emotions are in the driver's seat, you're destined for a crash.
Absolutely. It's the invisible force that separates the pros from the 90% of traders who don't make it. So stick with us as we break down why it matters, the emotional traps that catch everyone, and most importantly, how you can start building that mental fortress today.
All right, Mel, let's kick things off with the big question. When we say emotional discipline, what do we actually mean in a trading context?
That's a great place to start. A lot of people think it means being a robot, completely devoid of feelings.
Right, like some kind of trading terminator.
Exactly, but that's not it at all. Emotional discipline is about acknowledging your emotions, the fear, the greed, the excitement, but not letting them dictate your actions. It's the ability to execute your predefined trading plan regardless of the emotional roller coaster the market puts you on.
That's the perfect way to put it. You have to be the manager of your emotions, not a victim of them. The market is an environment that's practically engineered to provoke emotional responses.
It really is. You see a stock soaring and that fear of missing out, or FOMO, kicks in hard. Or you're in a losing trade and the fear of taking that loss makes you hold on, hoping it'll come back.
And that's where the plan comes in. Your trading plan is your rule book. It's the objective set of instructions you create when you're calm and rational. Emotional discipline is simply the commitment to follow those instructions when you're in the heat of the moment and your brain is screaming at you to do the opposite.
It's like being a pilot. When you hit severe turbulence, you don't just start yanking the controls based on panic.
Of course not.
You trust your instruments. You trust your training. In trading, your plan is your instrument panel. You have to trust it more than your gut feelings, especially when those feelings are amplified by market volatility.
I learned that the hard way early on. I remember this one trade. It was one of my first big ones. I had a clear profit target, but the stock was just flying. Greed took over completely. I thought, this is going to the moon.
Oh, I know this story.
Yup, I ignored my plan and held on for more and watched it come crashing all the way back down, turning a fantastic winner into a break-even trade. I was so mad at myself, not for the outcome, but for breaking my own rules. That was a painful but vital lesson.
And it's a lesson almost every trader has to learn. Your emotions will lie to you. They'll tell you this time is different.
Right.
But your plan, your data, your strategy, that's your source of truth. Without the discipline to stick to it, you're essentially gambling. And gambling leads to one thing: inconsistent and usually negative results.
So let's get into the specifics. What are these emotional monsters that traders have to battle every day? I think we should start with the big two: fear and greed.
The classic culprits. They're like the two puppet masters of the market, pulling traders' strings. Let's talk about fear first. It's so multifaceted.
It really is. The most common one new traders experience is the fear of missing out, or FOMO. You see a stock up 50% before noon, everyone on social media is talking about it.
And you feel this incredible pressure to jump in right now before you miss out on even more gains. You abandon all your rules about proper entry points and just buy, usually right at the top.
Exactly. You're buying based on hype, not strategy. And more often than not, you become what they call exit liquidity for the early birds.
Been there, done that. Then there's the flip side, the fear of loss. This can manifest in a couple of ways. First, it can make you sell a perfectly good trade way too early.
Right. The stock pulls back just a tiny bit, which is a normal part of any trend. But fear takes over and you hit the sell button, leaving a ton of profit on the table.
The other way it shows up is hesitation. You see a perfect A-plus setup that fits all your criteria, but you're so afraid of the trade being a loser that you just freeze. You don't pull the trigger.
And then you watch it run without you, which just feeds into the FOMO for the next trade, creating a vicious cycle.
A vicious cycle is the perfect description. Okay, so that's fear. What about its evil twin, greed?
Greed. Greed is what makes people blow up their accounts. It's the voice that whispers, this is good, but it could be so much better.
It's the reason people turn solid winners into losers. You have a stock that hits your profit target, your plan says to sell, but greed tells you to hold on for that home run.
Just a little more.
Just a little more, and you watch it reverse, go all the way back down past your entry, and now you're in the red. You let a winner become a loser because you got greedy.
Another huge one is over-leveraging, risking way too much of your account on a single trade because you have this feeling that it's a sure thing.
There are no sure things in trading.
None. Greed makes you forget that. It makes you take on way more risk than your plan allows, and one bad trade can wipe out weeks or even months of progress. It's the fast track to failure.
And we can't forget about some of the other emotions, like hope. Hope can be incredibly dangerous in trading.
Oh, absolutely. Hope is what keeps you in a losing trade. Your stop-loss level is hit, your plan is screaming, get out, but you hold on, hoping it will turn around.
Hope is not a strategy.
It is not a strategy. It's a recipe for disaster. It's how small, manageable losses turn into catastrophic ones.
And when that catastrophic loss happens, what comes next? Revenge.
Revenge trading, the absolute worst. You're angry, you feel like the market took your money, and you're determined to win it back immediately.
So you jump right back in. You take a sloppy, unplanned trade, probably with too much size, just desperate to make back what you lost.
Right.
And what usually happens? You lose again. Now you're deeper in the hole, even more emotional, and you're digging yourself a grave. Revenge trading is like trying to put out a fire with gasoline.
Okay, so we've painted a pretty scary picture of the emotional minefield that is trading.
We definitely have. But the good news is there are concrete, practical things you can do to navigate it. This isn't just a theoretical problem. There are real solutions.
Exactly. Let's shift gears and talk about strategies for building that emotional discipline. Where should a trader start, Melody?
It all begins before you even place a trade. Strategy number 1 is to have a rock-solid, written-down trading plan. I cannot stress this enough.
The foundation.
It's everything. Your plan needs to define with zero ambiguity your entry signals, your exit signals, both for taking profit and for cutting losses with a stop loss, and your position sizing rules.
Why is having it written down so important?
Because it makes it real. It's a contract you make with yourself when you are in a logical, unemotional state. When the market is going crazy and your heart is pounding, you don't have to think. You just look at your plan and execute. It removes the subjective, emotional decision-making from the process.
That makes so much sense. Okay, so you have your plan. What's next? What's strategy number 2?
Strategy number 2 is keeping a detailed trading journal.
The journal. So many people skip this step.
They do, and it's a huge mistake. A journal isn't just for tracking your profits and losses, it's for tracking your psychology. For every trade, you should write down not just the technical setup, but why you took the trade, what you were feeling when you entered, what you felt during the trade, and how you felt at the exit.
So you can start to see patterns.
Exactly. You might notice, hey, every time I take a trade out of boredom, I lose money. Or I tend to cut my winners short on Fridays because I'm anxious about holding over the weekend. Once you identify these emotional patterns, you can consciously work on them. The journal provides the data for your mental game.
I love that. Data for your mental game. Okay, what's strategy 3?
Developing pre- and post-market routines. Trading isn't something you should just roll out of bed and do. You need to prepare your mind.
Like an athlete before a game.
Precisely. Your pre-market routine could be reviewing your watch list, reading your trading plan rules aloud, and maybe even a few minutes of meditation or deep breathing to get centered and calm.
And the post-market routine?
That's for decompression and review. After the market closes and the emotional intensity has faded, you go back and review your trades from the day in your journal. You assess your performance based on how well you followed your plan, not on how much money you made or lost. This reinforces good habits.
That's a key distinction. Judge the process, not the outcome. Okay, let's do 1 or 2 more. What's strategy 4?
This one is simple but incredibly powerful. If you feel your emotions taking over, your position size is too big.
Oh, 100%.
If you're staring at every little tick of the chart and your stomach is in knots, you have too much money on the line. The fastest way to reduce emotional pressure is to reduce your size. Cut it in half or even by 3/4 until you can trade from a place of objectivity again.
It allows you to focus on executing your strategy correctly without the paralyzing fear of a significant loss. And finally, Melody, what's our last tip for today?
Know when to walk away. Seriously, strategy 5 is to take breaks. If you just had a massive win, you might feel euphoric and invincible, which can lead to reckless trading.
Right.
You step away, take a break. Let that euphoria settle. The same goes for a big loss or a string of losses. If you're feeling frustrated or angry, the best trade you can make is no trade at all. Close the laptop, go for a walk, and come back when you're level-headed.
Melody, these 5 strategies are fantastic practical tools. And that seems like a perfect place to wrap up. We've covered a lot of ground today, from why your mindset is your greatest asset in trading to the common emotional traps of fear, greed, and revenge.
And finishing with 5 actionable strategies you can start implementing right away. Build a trading plan, keep a journal, create routines, manage your size, and know when to take a break.
The main takeaway is this: becoming a successful trader isn't about eliminating emotions. It's about developing the discipline to ensure they don't make your decisions for you.
Well said. It's a skill, and like any skill, it takes conscious practice and repetition. Don't get discouraged. Start with one thing. This week, just commit to starting a trading journal. That alone can be a game changer.
Absolutely. Well, that's all the time we have for today. Thank you so much for joining us on Level Up Trading.
We hope this helps you take control of your trading psychology and level up your performance. If you found this episode helpful, do us a huge favor and subscribe wherever you get your podcasts.
And leave us a review. It really helps us reach more traders like you. Until next time, trade smart and trade with discipline.
Take care, everyone.